Good morning. Today is Tuesday, November 18th. I'm Joe Terril, president of Terril and Company Private Wealth Managers headquartered in St. Louis, Missouri. This is another update on our thoughts about the economy and investments for our clients and contemporaries that follow our thoughts and leads on several things. As we get started here today, we're going to do something a little bit different and talk about the economy and how important it is to try and get a handle on this economy. Is it getting ready to slow down radically because of things like inflation and people now beginning to maybe be a little worried if they're going to lose their job because of AI and et cetera. But let me start by introducing to those that don't know Kristen Wood. Kristen has been with us 4 or 5 years, and Kristen is head of administration. But we think it's important on our committees and talking about investments. The world is changing so much, so fast, that we have an opinion for somebody that obviously is younger than us, somebody that's still raising a family and raising children, as to what's going on out there. So I promise, Kristen, no one's going to ask you about GDP, but we are interested in what you and your contemporaries see going on right now in the economy. So
I think one of our viewers, Joe, said we were a bunch of old white men and we needed a fresh look. That's why we had Kristen here.
it's not so much a fresh look, but there is something legitimate to the fact, and I said this with Kristen when I asked her, Kristen, I want you to join the investment committee. It's not her bailiwick. For the 4 of us, it's always been stocks and bonds and valuations and potential returns. But on the other hand, all that is predicated upon the economy. And when I am out there in the real world and I see things that are going, hey, I don't understand this. What is all this? I generally ask somebody younger, like and Kristen, or somebody else tells me, here's what's going on, and I'm always surprised by it, but I do think it's very important towards this. So with that said, Kristen, thank you for participating and joining. And I'm going to put you on the spot right away. You mentioned that you participate in, I'm not sure what the term is, through Facebook?
A Facebook group.
A Facebook group of young people, mothers, are they all mothers?
Yes,
Mothers and
yes. All
and
mothers in the
all
St. Louis area.
Your age, and you guys ask each other questions and survey back and forth about what you're doing and what you're not doing.
Yes, and you get a very good look about how people are spending their money, you know, where everyone's hurting. A lot of complaints about how much groceries are right now. And yesterday I did a poll, who is maxing out their IRA contributions? And it turns out a majority of people are not. I don't think that our generation is as focused on that. You know, we're the epitome of consumerism. Saving is on the back burner, especially with daycare prices, and now we're really getting hurt by food prices. Just about any other activity you do now. I mean, throwing a birthday party can put you back $1,000 easily. And, you know, you try to keep up with the standards of, you know, it's kind of keeping up with the Joneses. You know, what do you say to your kids? No, we're not having a birthday party this year because of inflation.
Right.
So people are, you know, hiking up their credit cards, you know, trying to figure it out by doing balance transfers. You know, now you can do layaways, you can On DoorDash, you can use Klarna, which is basically you can make 4 interest-free payments. You know, people are utilizing all of that just to kind of get back to the normal, you know.
Well, it does lead to what us old men talk about, which is the belief that the economy is kind of fragile right now, because if those generational people cut back on spending, then the economy is going to struggle, and with it will be the markets are going to struggle too. The markets are set up for the fact that the consumer is going to continue to spend, there's no problems. Personally, I'm not so sure that can they deal with this. I'll real quick mention that just a number, because I think there's some people out there that think of it that way, that if we ran a few years ago 10% inflation and now we're running 3% inflation, that does not mean prices fell by 7%. Like some people are thinking. No, it means now 10% followed by 3, you have 13% inflation. Throw more on top of it, you can see why at the food store and things like that, people are trying to figure out how can I afford this and still have any discretionary spending. So I think it is a legitimate issue for the economy right now, inflation as well as the psychology of the husband and wife both have jobs, but if, and Kristen, maybe throw your 2 cents in on this, if they're worried about, well, I wonder if I'm going to lose my job to AI, or I wonder if I'm going to lose my job for whatever reason, they're not going to spend and they're going to cut back.
I think there are real concerns about AI. I have quite a few friends that are very concerned about it. But I don't think any changes with their finances are being made until that actually happens.
I want to go on to mention one other thing that's timely from this morning, just to get an idea for our viewers of this economy and what we're dealing with. Home Depot had earnings this morning, and they were okay, but Home Depot kind of gave you the impression business isn't that great and the consumer is not taking on a lot of building projects. On the other hand, James Hardy, who makes building materials, also had earnings out, and they were more upbeat and, you know, acting like, yeah, business is pretty good. So here's the economy with somebody manufacturing building materials optimistic, somebody retailing them not optimistic. What's the true side of this story? So in the time frame we have left, Bill, I want you to chat just briefly about what we're doing with investments and why we're doing it, particularly from the equity standpoint.
Sure. Thanks, Joe and Kristen. So we continue to stay disciplined, right? This is not a market environment where you want to make bold bets. So we're sticking to our discipline. We're buying what we would call, you know, underloved stocks with cheap valuations. So just to review some quick names, Globus Medical, which trades GMed, had a very strong third quarter. Warner Brothers, which is a name we've owned for some time now, is continuing a process to basically be sold. There are several bidders looking at the company now. We hope that'll be resolved by the end of the year.
The key statement there, though, is when we bought those positions, they were underloved.
Right, absolutely.
Nobody wanted them, nobody liked them.
No, nobody liked these companies, and they've kind of turned some things around. Solventum, which was a spin-off of 3M, really executing well, rationalizing their businesses and paying down debt. So, you know, again, sticking discipline. We've been buying Caesars Entertainment in the gaming space. Again, another name that's got some debt, but mostly in leases. And, you know, they'll work their way out of it. So that's kind of our, focus. We've been buying some energy infrastructure names like Western Midstream and ClearBridge Energy, where we get 9% distribution yields, and we think it's a great way to cash flow portfolios while things are a little bumpy in here.
Let me turn, Dave, interest rates, they're stubbornly on the long end staying up, which is good for the way we have our portfolio structured.
And we've been talking about that for a while now, Joe, and you think the Fed lowering interest rates will lower all interest rates. And what's really fascinating, September of 2024, the Fed first started this rate cut cycle. The 10-year was at 3.70, and Fed funds were at 5.5. Today, Fed funds are at 4, and the 10-year is at a 4.10. So that has not brought long rates down. Even you go shorter, the 5-year and the 2-year treasuries basically their yields have not changed in that period of time, with a 150 basis point drop in Fed funds.
It is our belief that interest rates, particularly on the long end, are not going to go down, and if anything, they're going to go up. The more historical spread over the rate of inflation that people look for is coming back, and I think that's a big part of the reason why, in spite of the Fed cutting short rates and talking about cutting them some more, the long-term rates are not going down. Therefore, that'll relate to the economy a little bit too. But as we begin to run out of time, Russ, talk about what's happened since our last video with markets, and tell our viewers what our thoughts are between now and the end of the year.
Okay, thank you, Joe. I think you guys characterized it pretty well. I mean, if you look from the market highs, the Dow is down roughly a little less than 4%. NASDAQ's down about 5.5%. I think the area that's kind of gotten hit the most, small cap stocks, down about 8%. And so markets, you're talking about the economy and kind of maybe wrapping it up on the economy. Things are getting a little bit more cautious. The government's been shut down. Data isn't as readily available, so that is adding to the confusion. You had mentioned James Hardy and Home Depot. I think you could put the same thing on the economic news with Atlanta Fed GDP printing 4.1%. That's the forecast. So there's confusion on the economic front. I think Kristen's points are well taken about the consumer. I think we see that in our individual business with the number of client requests we're receiving for distributions. In terms of the markets, they're reflecting all those concerns, economic, interest rate concerns that David brought up. There's some things that consumers are doing, to Kristen's point and David's point. They're able to move credit cards around to lower interest rates right now. And interest rates are going to be interesting, right? What is the Fed going to do? Are they going to lower rates? Are they not going to lower rates? All that reflects in an uncertain market right now that's being reflected. We'll see what happens between now and the end of the year. I think volatility will be one tomorrow. You get a big print after the close with NVIDIA earnings. And then you have options expiration on Friday, which creates volatility too. So all that said, I think we're kind of in uncharted waters here versus where we've been. We continue to have a disciplined, cautious approach to client portfolios, and I think it's working for our clients.
Russ, thank you. Thanks to our other comments here. And Bill mentioned it. We're staying very disciplined and always looking out for what risk might be out there for investments. With that said, Brian Curtis, thank you for helping us produce the update, and we'll be back in 2 or 3 weeks, particularly as maybe we can get some more actual statistics on the economy. Thank you for watching.